You are listening to Charting Wealth, the book, Chapter 6. Please listen and give us your comments at the end and any kind of suggestions you have. We really appreciate your help. This one is on Trendlines. Let's jump right into the material. The trend is your friend. Never forget this old stock trading adage. With stock charting, the trend is our best friend. Now, why is that? Well, we are trend followers. We are not forecasters, and we carefully wait for a trend, whether up or down, to emerge from movement in price as seen in the candlesticks. When we locate a trend, we follow it. Once we have a rollback on our short chart in the opposite direction of the larger charts, we can begin looking for a possible rollover in the direction of the longer trends. When this rollover occurs, it's our trigger to enter a new trend. Now, a new trend begins whenever the Price Percent Oscillator, or PPO, crosses over the signal line on our weekly chart. When this occurs, it signals a weekly vertical crossover, and we begin looking for an opportunity to draw a new trend line and adjust it as new candles are formed and closed. Trend lines never extend through crossings of the PPO over the signal line. At this point, we look to draw a new trend line in the opposite direction. Now, beginning chart readers are sometimes confused when they draw trend lines, but the rule is simple. Bottom up, top down. This means when price movement is going down, draw the trend line from the top of the candlesticks. Conversely, when price movement is going up, draw the trend line from the bottom of the candlesticks. The goal is to attempt to connect 3 or more candle tops or bottoms in order to have an acceptable and reliable trend line. The more candlesticks you're able to connect, the more reliable the trend itself will be. Solid trend lines give us more confidence to enter trades. Trends start to fail when candlesticks penetrate the trend line. When price movement goes flat or even in the opposite direction, the trend may be failing. There is, however, another alternative. Price movement can and does back up. Many times backups occur when there are extreme movements in price, whether up or down, and the market needs time to digest the gains or losses before continuing in the same direction. When digestion is occurring, the indicators can be expected to continue pointing in the same direction. If the indicators rotate over in the opposite direction, this is not a backup, but a change in the trend. Whenever the trend line is violated and indicators are rolling over, we should consider getting out of the trade, particularly if the Price Percent Oscillator, the PPO, which is our primary indicator, is close to crossing over or is crossing over the signal line in the opposite direction. Solid and sustained trend lines give us more security that the PPO, the derivative oscillator, or DO, and the candlesticks are giving us accurate signals as to future price movement. Failing trend lines can be an early warning signal that the market is changing, that market changes are actually underway. Now, if I had no indicators and only candlesticks, trend lines would be enough to help me trade and have the confidence to get into and out of the market. Always attempt to establish reliable trend lines. When you cannot do so or a trend line fails, watch the charts carefully, that is the indicators, and pay particular attention to the PPO, the Price Percent Oscillator. Remember, you can use trend lines on all of your charts. The double long, that's the weekly. The long, that's the 2-day. And the short, or the 4-hour or half-day chart. If you had no other technical assistance other than price movement, you should be able to trade with just trend lines. That's Chapter 6. Hope you enjoyed it as we continue to push through this book. We really appreciate your feedback. God bless. All the best from the entire team here at Charting Wealth World Headquarters, chartingwealth.com.